My next guest studied the European situation closely during a 28-year tenure at the International Monetary Fund, where he was the acting director of the IMF's European Department. Alessandro Leipold is now a chief economist with the think tank, the Lisbon Council, and he joins us from our Washington bureau. Mr. Leipold, welcome to Bottom Line. Thanks for coming on today.
Thank you.
Sir, today, European Commission President Jose Manuel Barroso called for a stricter accounting of European banks' exposure to sovereign debt, and he also called for banks to hold more capital. Global markets liked what they heard. Are European officials being given the benefit of the doubt here?
Yes, they are being given the benefit of the doubt, and obviously there's some very, very important deadlines coming up on which they better deliver. They are sort of drop-dead deadlines, the October 23rd European Council Summit and the G20 meeting in early November. Mr. Barroso essentially said some good things. He did say the main point regarding the banks was that they were going to look for a fully coordinated approach to a significantly higher capital ratio of high-quality capital. Now, that's fine, but it does beg a number of questions. First of all, no number was attached to this significantly higher ratio. Is it the 9% of Tier 1 capital that has been floated around, was mentioned in an FT article today, is apparently the number favored by the European Banking Association? Is there going to be a long discussion on that? And if so, anything lower would certainly be a disappointment. And also, what does fully coordinated really mean when it looks very much like rather every bank for itself, because first of all they have to try to go on the markets, then every nation for itself, because the government, they have to turn to governments, and only if all of that doesn't work can they turn to the common fund, the European Financial Stability Fund.
Sir, Mr. Barroso also warned that key European banks shouldn't be allowed to pay out dividends or bonuses until they've raised their capital buffers to the new standards. Those rules, they're supposed to take effect in 2019, but given the gravity of the situation in the Eurozone, will those rules have to be implemented much earlier?
I wasn't aware that they're going to take effect only in 2019. If that is accurate, then it's really a big downer. Yes, of course, to be effective in any way, they should be immediately effective. I mean, until they reach those goals, they should not be allowed to pay out dividends, and every effort should be made towards achieving the targets.
Well, the big concern now is that European banks could take big losses on bonds they own from governments with unstable finances. How's that fear affecting lending between banks and to the economy as a whole?
Well, it is affecting lending between banks quite severely. There's a lot of distrust, not dissimilar from what was happening just before Lehman's collapse in 2008. Interbank lending has dried up. Banks much prefer parking their money overnight at the ECB. The money left with the ECB overnight has reached record levels, and that, of course, then dries up lending to the private sector. That is a major concern, and I think probably driving, finally focusing the minds on the close connection between the sovereign debt crisis and the banking crisis, which is a constant in all debt crises. The two are twin crises and should have been addressed much earlier.
Well, during this summer's stress test, European lenders didn't have to prove they had enough capital to absorb potential losses on bonds that they plan to hold until they mature. Now they do. How does that change the dynamic?
Well, I'm not sure what the new stress tests are going to require of them. Certainly, the past stress tests lacked credibility precisely because they didn't live up to their name. A stress test has to contain the largest stressor out there, which is obviously a sovereign default, and that was not part of the sensitivity scenarios. So including it will certainly mean that you're going to find a need for much more capital recapitalization than was calculated in July, which was a really tiny figure affecting only a very small number of banks. Not only that, the follow-up even in those cases was not really very rapid and very implemented quickly. So, no, I think, we're looking at multiples and multiples of the numbers that were mentioned back in July.
Now, Mr. Leipold, we have a little more than a minute left. The political parties in Slovakia, they've reached an agreement agreement to approve Europe's enhanced bailout fund. There's going to be a second vote on the European Financial Stability Facility, this one after lawmakers rejected the first vote yesterday. There was a statement from Fitch Ratings in London, and that statement read in part that political uncertainties like the one playing out in Slovakia threaten to prolong the euro region debt crisis. How do you remove the political impediments?
Well, that's pretty difficult to do, and especially since they seem to be determined to continue to take decisions within the Eurogroup ministers of finance, which is clearly a very political group of people. And even for the EMS, what is going to be the ESM, sorry, the permanent crisis fund that's supposed to be set up in 2012 now, according to Barroso, the main decision-making body is going to be made up of the Eurogroup ministers of finance. Mark, I know we have little time, but more than Slovakia, I think our eye should also be on what is happening in Italy, where the government yesterday lost a vote, went down by one vote. There will be a confidence vote in the next few days. They have a huge debt issue tomorrow. All of these things bear watching as well.
Alessandro Leipold, chief economist with the think tank, the Lisbon Council, joining us from Washington. Mr. Leipold, thanks for your perspective. We appreciate it.
Thank you, Mark.